Hello, hello. The last chapter in the textbook. Yippee. Okay, we made it. Chapter 16 talks about everybody's favorite topic, money. So let's look at the learning objectives as we always do. Explain what money is and what makes money useful. That should be a relatively easy one, right? Describe how the Federal Reserve controls the money supply. Trace the history of banking and the Federal Reserve System. Classify the various institutions in the U.S. banking system. Number 5, briefly trace the causes of the banking crisis and explain how the government protects your funds during such crises. Describe how technology helps make banking more efficient. And finally, evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. So Jerome Powell, he's the chair of the Federal Reserve. He became chair in 2018. He was the first chair without a degree in economics. Worked as a lawyer and investment banking. He's the guy who's in charge now. So why is money important? Like, kind of silly question, don't we think? So what is money? Money is anything that people generally accept as payment for goods and services. We don't typically think of it in that context, but that's really what it is. Years ago, like centuries ago, we worked on a barter system where the direct trading of goods and services was done in place of using money as a payment. Standards for a useful form of money. So what should money be? Portable, for one, right? You want to be able to put it in your pocket, take it with you. Divisibility, stability. You want to be able to count on that money being worth something. Durability. It has to last for a while. And finally, uniqueness. There's also e-money, right? Like your debit card from your bank. Now, the money supply is the amount of money that the Federal Reserve Bank makes available for people to buy goods and services. We don't think about this much either, but there is a limit. There are a limited number of bills, dollar bills and coins that can be used to buy goods and services. And the money supply is broken down into 3 descriptives, if you will. M1 is money that can be accessed quickly and easily. Coins, paper, traveler's checks. In financial accounting, we would call those liquid assets. M2 is M1 plus money that may take a little more time to obtain. So, for example, savings accounts, mutual funds. Why does it take a little more time? Because you got to go to somebody to ask for your money back. M3 is M2 plus big deposits like institutional money market funds. Inflation is something that we've been talking a lot about. You've been reading about it in the news, certainly for this year. Inflation is typically defined as too much money chasing too few goods. So what that means is people have a lot of cash, but there aren't a lot of things to buy. So supply and demand from Econ 101, right? The price goes up. That's inflation. In deflation, prices go down because of a surplus of goods and services compared to money. The size of the money supply can affect employment and economic growth or decline, depending on what's happening. 5 major parts of the Federal Reserve. That's what we hear about in the news as the Fed. There's a board of governors. There's the FOMC, the Federal Open Market Committee. There are 12 Federal Reserve banks, 3 advisory councils, and then the banks that are members of the Federal Reserve System. So banks are required to have a certain amount of money kept, a certain amount of cash in their vaults. So when Federal Reserve requirements increase, the banks put more money into the Fed, reducing the amount of money available, the money supply. Thus, there is less money available to lend to customers. If there's less money to lend, there's less money to spend, the economy slows. Now, on the other side of the coin, if the reserve requirements are decreased, that means that banks have to put less money into the Fed, meaning there's more money available to lend to customers, and therefore the economy gets energized. It speeds up. And when we talk about speeding up, what we really talk about is people spending money. That's what the speeding up is. Open market operations. Well, in the open market operations, the Fed buys and sells bonds. Right? If the Fed sells bonds, then the money flows from the economy to the Fed, right? Because people buy the bonds, so cash comes out of the economy and they get bonds in its place. So we slow down the economy because there are less dollars available to have. On the other side of the coin, if the Fed is buying bonds, that means they're putting money into the system, and that again speeds up the economy. So you can see how the Fed is responsible for these monetary operations. It's called monetary control. Managing the discount rate is the Fed's it's their big cudgel, if you will, for those of you who know what a cudgel is. It's their big cudgel on inflation. So the Fed has a rate that it charges banks to borrow money. If they increase that rate, then the banks borrow less from the Fed, which means there's less money to lend, which means that the economy slows down because customers have less money to borrow. Businesses have less money, so they can't expand and that sort of thing. When the Fed decreases the rates, what they're trying to do is they're trying to speed up the economy. Now, the Fed decreased the rates during the big recession that started in 2008. The Fed decreased their rate to 0 because the economy was just stopped. And in order to get the economy moving and keep it moving, the Fed reduced their rate to 0, which meant that banks weren't paying anything to borrow money, which meant there was lots of money available, and that was the impetus that the Fed gave to the economy to speed up. Over the last year, and you're going to see that in your discussion question, the Fed has been increasing rates significantly. Why? Because they want to slow down the economy, because inflation has been running 7 to 8%, which is far higher than the 2% that they expect. So here's your check clearing process for those of you who still write checks. Okay? So, number 1, the buyer, the farmer in Quince Orchard, Maryland, writes a check. The seller, the tractor dealer, takes that check, deposits it into the local bank in Austin. That bank sends the money to the Federal Reserve Bank in Dallas, which then sends it to the Federal Reserve Bank in Richmond, which sends it to the local bank in Quince. So the money now comes back and goes to the Federal Reserve in Dallas. Essentially, though, this isn't money transferring. These are computerized transactions. So they're moving money from one account to another from the banks to make sure that things get paid. The Federal Reserve System was started under the Federal Reserve Act in 1913. All federally chartered banks had to join the Federal Reserve. It was in response to what happened, as it says, in 1907, there was a cash shortage problem. During the Great Depression, the stock market crashed, and it led to bank failures. And what happened there was people wanted to get their cash out of the banks because the market crashed. Well, if everybody goes to the bank to get their money out, it's not all there. Remember, we talked about the Fed putting a percentage reserve requirement on the banks, which means that maybe out of the money that they have that's been deposited in the bank, maybe the Fed says you got to keep 20%. So if there's $100 in the bank, there's only $20 actually in the bank's vaults. The other $80 has been loaned out for mortgages, for businesses. So if every customer of the bank goes to the bank to get money, there's not enough cash there. So in 1933 and 1935, Congress passed legislation to strengthen the banking system, including the establishment of what was called FDIC, the Federal Deposit Insurance Corporation. And what that did was that gave federal or government guarantees to depositors in banks for specific amounts. This banking system, you have commercial banks, you have savings and loans, credit unions, and non-banks. So commercial banks, obviously, those are the profit-seeking banks. So we're talking about Wells Fargo, those kinds of big banks. They get deposits from individuals and corporations in the form of checking and savings accounts, and then they use that money to loan out. A commercial bank has two types of customers: depositors, people who put money in; borrowers, who take money out. So, commercial banks, demand deposit, meaning I put a deposit in and on demand I can get it out. They have time deposits. They have certificates, CDs. If you've ever bought a CD, typically CDs are for a period of time. So say you buy a 6-month CD, once you deposit your money in that CD, you can't touch it for 6 months, until it comes due. Services to borrowers, loans are given on the basis of creditworthiness. Now, savings and loans, or S&Ls, often known as thrift institutions because their original purpose was to promote customer thrift and home ownership. Many failed in the 80s and 90s. So your savings and loan is more of a, if you've ever seen It's a Wonderful Life, go see that movie. It's all about savings and loans. Credit unions. I belong to a credit union. Many union employees or many union people will belong to a credit union. It's a nonprofit, member-owned financial cooperative that offers the full variety of banking services, but they have better rates because you're a member. It's kind of like a Costco for cash. Protecting your funds. Here's the FDIC that we talked about a minute ago. It's an independent agency of the U.S. government that insures bank deposits. This changed. This used to be $100,000. Now they cover bank deposits up to $250,000. Savings Association Insurance Fund, similar to the FDIC for savings and loan associations. And then there's the National Credit Union Administration, provides up to $250,000 coverage per individual depositor per institution. So remember, with this insurance, with this bank insurance, there is a limit. So if you have a deposit, if you have an account that has $300,000 in it, you could lose that $50,000 over what's being covered by the insurance. Technological advances, EFT. EFT is electronic funds. That's the way most payments are being made today. Quicker and more economical than paper checks. Includes electronic check conversion, debit cards, smart cards, direct deposits. Typically, what the federal government did several decades ago already was decide that payroll deposits had to be made by EFT. There were no more checks. You've got debit cards, which, remember, a debit card is simply tied directly to your account in the bank. Smart cards combines a credit card, debit card, phone card, so it's got the whole deal. The leaders in international banking, obviously the United States, has the largest economy. About $5 trillion is traded daily in currency. Net result, one interrelated system with no regulatory control, and banks make investments where they get maximum return, which is what any investor does. Banking is no longer strictly a domestic issue. We're talking international here. And that's it for that chapter. So chapter 16 is done. You and I are finished with the textbook. We move on to the rest of the responsibilities you have for the semester. Again, I am available for Zoom meetings, for phone calls, for text messages, Had a lot yesterday. So get in touch if you've got any questions. Otherwise, take care and have a good week.